All right, let's get right into it. VinFast's latest earnings report, wow. It tells this really dramatic story of just insane growth on one hand and massive, massive spending on the other. We're going to break it all down. This is a company moving at an incredible pace, but as you're about to see, that kind of speed comes with a pretty hefty price tag. So the last quarter of 2025, it was, by pretty much every measure, the company's strongest ever. They put up some truly eye-popping numbers that really show you just how fast they're scaling up. The headline here, the big story, is all about massive, explosive growth across the board. I mean, when you just look at the top-line figures, it is crystal clear that VinFast is selling cars at a rate they have never, ever hit before. Get this. Revenue in the fourth quarter shot up an astonishing 139% compared to the same time last year. It hit $1.6 billion. That kind of year-over-year jump is it's almost unheard of in the car industry. And this chart right here, this really shows you where that money came from. It's a massive 63% jump in EV deliveries compared to the year before. They pushed over 86,000 electric vehicles out the door in just the last 3 months of the year. And for the whole year, the number is nearly 200,000 vehicles. That's more than double what they did in 2024, and they even beat their own targets. That number alone just gives you a sense of the sheer scale of their production ramp-up. So how does the company's leadership see all this? Well, they frame this crazy growth not as some reckless sprint, but as part of a really long-term, disciplined plan to make EVs available to everyone. In their view, this huge investment is just a necessary step to get there. But, and this is a big but, that explosive growth comes at a serious cost. And that brings us to the other side of the coin. The amount of money they had to spend to hit those delivery numbers is just as staggering as the growth itself. Now, take a look at this table. It's really interesting because of the contrast. On one side, you've got that huge $1.6 billion in revenue. Awesome, right? But look right next to it, a negative gross margin of almost 40%. Simply put, that means they're losing a chunk of money on every single car they build. And that's before you even count other costs like R&D or marketing. And here's the bottom line. Despite selling a record number of cars, the company still posted a net loss of $1.4 billion in just 3 months. That number just screams how much cash they're burning through to fund this whole global expansion. It's also really important to understand who's buying all these cars. Check this out. About a third of their deliveries in the fourth quarter went to what they call related parties. That's mainly the EV ride-hailing service GSM, which, you guessed it, is also part of the bigger Vingroup family. And to add a little more red ink to the pile, there was this big one-time accounting charge. They had to write down $236 million for their planned U.S. factory in North Carolina, basically because the project's timing has been pushed back. So, okay, the big question. How does a company that's losing over $1 billion in a single quarter plan to turn things around? Well, VinFast has actually laid out a pretty clear strategy to cut costs and hopefully carve out a path to actually making money. A huge piece of this puzzle is something called the bill of materials, or BOM cost. Just think of it like the recipe cost for a car. It's the price of all the parts that go into it. Getting that number down is absolutely critical if they want to get rid of that negative gross margin. So, their game plan really boils down to 3 big things. First, get huge on a global scale to be more efficient. Second, attack the cost of each car by redesigning them. And third, develop their own tech so they have more control. Okay, so step 1, scale. They're building out their manufacturing network all across Asia. They've got 4 plants aiming for a combined capacity of 600,000 EVs a year. It's that classic idea, right? The more cars you make, the cheaper each one gets to produce. The US factory is still on the map, but now they're targeting a 2028 start date. Step 2 is all about optimizing costs by basically redesigning the guts of their vehicles. Their new EE 2.0 architecture is all about making things simpler. Fewer electronic boxes, less complicated wiring, all designed to lower that recipe cost we were just talking about. And step 3, they're pouring money into their own technology. We're talking everything from driver assistance systems and battery research to using smart robots in their factories. The goal here is pretty simple. Control your own destiny, control your own costs, and own your innovation. So all of this, it leads to the one fundamental question that's hanging over the company as it looks to the future. They have a clear plan, no doubt about it. But pulling it off is going to take a ton of time and a tremendous amount of cash.
Ultimately, what we're watching is a high-speed, high-stakes gamble on growth and technology. The big question is, can they build this profitable global EV giant before the immense cost of that dream becomes too much to handle? The race is definitely on.